So we've got a bunch of charts that we're going to run through here. Let's start first with the major central banks' total assets as they continue to rise, and help us understand just kind of contextually, like, why is this chart important, and what does it really tell you as you look at it?
Yeah, so I mean, there's a couple of things. Like, one, we have this new technology, right? We have Bitcoin, and so many people are trying to figure this out, and there's a lot of noise in like the so-called crypto space, right? We all know this, but really, I think what's happening and what's forcing people to adopt this technology, this monetary technology, is we're kind of at the end of this long-term debt cycle, and most people don't really understand this, especially if they're not studying macroeconomics or have a in-depth history of monetary assets and debt cycles, right? But starting in 08 and in 2020, we kind of hit the zero lower bound, and so central banks kind of ran out of their main option, the firepower, which is interest rate policy. And so what they went to is quantitative easing. It's essentially just stuffing a bunch of cash in the bond market, or really, I mean, simplify it as printing money, right? But it's really just lowering the discount rate of or the cost of capital everywhere on the planet. And so these are all the global major central banks. And what this is just showing is that they're trying to keep the system glued together. But it's cracking. It's cracking at the seams. And so this is actively forcing people into Bitcoin or to seek shelter elsewhere.
And so when we look at the total assets, obviously every major central bank just absolutely took off in 2020 for obvious reasons. But also in the United States, we've got this debt chart that shows a very similar type of growth there at the end in 2020. So explain what's going on here.
Yeah, so this is looking at just like total debt to GDP, non-financial, financial. And right now, total debt to GDP is at 400%. And so my good buddy, Greg Foss, he was on your show. He likes to always talk about how it's a mathematical certainty that fiat will debase because of basically this chart with debt to GDP at 400%, given that all debt has to be repaid plus interest, unless the economy is growing at 12, 15% a year in real terms, then we're in a debt spiral. And there's really no way out unless it's default, which is politically not feasible, or to basically debase the currency. And so that's the game we're playing. And really, a lot of people get upset with the puppets of the game, but it's more systematic than that. It's not about Trump or Biden or Powell or whoever you want to call shots at. And I get it. I do it too sometimes. But it's systematic. We're in a debt spiral, and mathematically, there's no way out of this except to continue printing and attempting to kick the can down the road. But more and more people are waking up and saying, I don't want to play this game.
Yeah, I think that's a great way to describe it. We've got a chart here of the real 10-year Treasury bond yield. Describe what's going on with the 10-year yield, but also what the relationship between the 10-year yield and inflation is.
Yeah, so the Fed, or like the government's way of measuring inflation, I believe is kind of flawed. And I think most people that are paying attention do as well. But just for the sake of the argument, we'll use it. It's, there's PCE or CPI, but it's basically just consumer price inflation. And we're indexing that against what a treasury bond could get you, what a lot of people in financial markets, they use as their risk-free rate. Then what you're looking at is essentially in this chart, when you break that zero lower bound, the cost of capital is negative, right? So when you're evaluating stocks, real estate, any asset, when the cost of capital is negative, what's the fair value? And the answer is it doesn't compute. It breaks. So if you're holding a bond, or if you're sitting on a 60-40 portfolio, if you're in your pension or your 401k, you're losing in real terms. And even if nominally you're making out okay, you're basically getting pillaged if you're holding bonds or a lot of these financial assets, because the cost of capital is so distorted, and that's because it's a centrally planned market. And so I think these are like the broad macro trends here, and this is why I think Bitcoin would be important regardless. And Satoshi literally released Bitcoin because of these problems. I think he chose to release Bitcoin kind of strategically, but this is why Bitcoin is especially so important.
What's up, guys? Bang, bang. Thanks so much for watching the Best Business Show today. If we're going to be the best business show, we obviously need the best partner. That's why the exclusive sponsor of the Best Business Show is SoFi. They're an all-in-one platform that allows you to invest in all kinds of different assets, including stocks, ETFs, crypto, IPOs, and they even have an automated investing function, if that's your thing. So before we start getting after it again, make sure that you go download SoFi, you get an invest account, and when you make your first crypto trade, regardless of what you buy, they'll give you $10 in Bitcoin for free. It's that simple. Head on over to SoFi.com/pomp to get started today. Thanks so much for watching, and I hope that you come back and watch more of the Best Business Show tomorrow.